and thank you for watching this month's Dechtman Wealth Management Financial Insights. In this month's video, I'll discuss some of the major headlines that influence markets in December. I'll also provide insight into what the new tax plan means for investing. 2017 was a great year for markets in the United States and internationally. All major economies showed signs of growth, which is rare as it has only happened a few times over the past 50 years. Specifically in the US, there was minimal volatility with slow and steady growth that kept pushing major domestic indexes to new record highs. However, in the last week of December, all three major domestic indexes posted losses, which pulled them back from their highs. Despite this dip, the S&P 500, Dow, and NASDAQ were each in positive territory for the month and achieved a number of records for the year. In fact, December marked the 9th month in a row that the S&P 500 and Dow recorded gains. The S&P 500 hadn't seen a string of performances like this since 1983. For the Dow, the stretch of gains was even more unusual. Its last run of consecutive months like this was in 1959. The NASDAQ also experienced a year of noteworthy gains. In 2017, the index rose in all but 1 month for the first time ever. Overall, each index posted double-digit gains for the year. The S&P 500 gained 19.42%, the Dow increased 25.08%, and the NASDAQ was up 28.24%. Probably the biggest economic event that occurred in December was the passing of the largest tax reform in over 3 decades. At the start of 2018, many changes are already in effect. The corporate tax rate has now dropped from 35%, which was one of the highest in the world, to 21%. Individual tax brackets have also changed. The standard deduction is double what it was in 2017. We'll discuss how the new tax plan may affect investors in just a bit. The revised third quarter gross domestic product, or GDP, indicated that the economy grew by 3.2% between July and September. Data suggests that the fourth quarter may have had similar growth as well, although we'll have to wait to receive the initial readings. What we do know is that both existing and new home sales jumped in their most recent readings in November. New home sales grew faster than they have in 25 years. Consumer spending also grew in November, increasing far more than analysts expected. While measures of consumer confidence slipped from the 17-year high we saw in November, they still stayed high in December. The Federal Reserve seems to agree that the economy is strengthening. Last month, the Fed raised interest rates for the third time in 2017, pushing the benchmark rate from between 1.25% to 1.5%. It also increased its estimate of how quickly the economy will grow in 2018. One soft spot among the data we received, however, was the value of the US dollar, which decreased over the last 3 months of the year. Some analysts anticipate the dollar could continue to struggle in 2018 as the Fed considers continuing to raise rates and other central banks potentially following suit. While the economy is not perfect, overall, December gave us a lot of good news to round out the year of many record highs in the markets and positive economic data. We look forward to seeing what is in store for 2018, and we'll continue to share our perspectives with you along the way. Now, let's discuss what the new tax plan means for investing. The new tax law leaves the investment world mostly untouched and perhaps better positioned to take advantage of a rosier and potentially more robust marketplace. Favorable rules for 401ks, IRAs, and other retirement accounts remain intact. The law, however, prohibits taxpayers from reversing Roth IRA conversions for a certain amount of time, which were used by account holders if investment values decline. Americans don't have to pay income taxes on Roth IRA withdrawals. Although the estate tax wasn't eliminated, the plan raised the federal exemption for individuals from $5.5 million to $11 million, and for couples from $11 million to $22 million. The plan also boosts the alternative minimum tax, or AMT, from $50,600 to $70,300 for individuals, and from $78,750 to $109,400 for married couples filing jointly. The AMT's aim was to prevent high earners from skirting full income tax payments by increasing the number of deductions. The AMT, a mandatory alternative to the standard income tax, takes effect when taxpayers' income reaches certain levels. Sole proprietorships, partnerships, and S corporations would pay taxes at individual rates but be allowed to use the 20% income deduction. This provision would not apply to high earners making more than $315,000 and filing jointly as couples. So, what should you do now? Take a look at previous year's tax filings to determine the differences in your tax situation. If it appears that your tax rate may drop or your ability to itemize changes, you may want to consider making changes to future contributions, such as charitable donations or deductions, which may include medical expenses. Retirees will benefit from the increase in the standard deductions for charity. To gain the most advantage, experts suggest doubling donation sizes but giving less frequently. For example, giving more in a single year and then skipping the next year, taxpayers would have a higher amount to write off on their taxes. How you choose to donate to a charity is also important. Opening a donor advised fund could be better than donating cash. Retirees will also have to monitor their income, withdrawals from their retirement accounts, which are taxable, to avoid moving into a higher tax bracket. Retirees approaching 70.5 in 2018 may want to start taking early distributions if they have high balances in their retirement accounts to avoid landing in higher tax brackets. That is all I have for you this month, but don't forget to tune in next month for another economic and educational update from Dechtman Wealth Management. If you would like to discuss your personal financial situation or have questions on the new tax law, please give us a call today at 303-741-9772. We look forward to speaking with you.